Okay. Good afternoon and welcome to Sensible Financial Planning's webinar, Retirement Plan Basics, Part 1, Plan Options. I'm Carrie Fristow and I'll be your moderator today. Sensible Financial's founder, Rick Miller, today will be speaking about some of the retirement plans that are available to you and how to choose from among them. Rick holds a PhD in economics from the University of Chicago and started Sensible Financial 20 years ago. He is also a certified financial planner. Today's webinar will help you better understand your retirement plan options and also highlight some of the choices you can make to improve your retirement savings results. You can register for upcoming webinars through a link in Sensible Financial's newsletter, which will be published later this month, or at www.sensiblefinancial.com/webinars. There will be two Q&A sections during this particular webinar. And if you have questions during the webinar, please submit them through the Q&A link, which should be at the bottom of your screen. Rick will answer as many questions as he has time for, once midway through the presentation, and then once at the end. Unfortunately, he can't give personalized advice in this setting. There really isn't time to gather the information or the context necessary to do that. We will provide contact information for Rick at the conclusion of the webinar, and we'll be sending you a link to the recording as well. Now, Rick will begin.
Thank you, Carrie. Everyone knows that retirement plans are good. Motherhood, apple pie, and retirement plans. And today, we're going to talk about why they exist, why they're good, and some reasons to choose one or the other from the choices that are available to you. Almost everyone retires. Almost everyone works, in this case, participates in the labor force. And you see here that by their late 20s, 90% of men and 75% of women, I guess it's this one that I want, 90% of men and 75% of women are working. By the late 60s and early 70s, only 20% of women and 30% of men are still working. And by the late 70s and early 80s, we're down to 5 and 10%. So just about everybody retires. Now, if future you isn't working and earning, but is still spending, the money has to come from somewhere. If now you spends their entire earnings, and now you is the person here, and the person here, future you, who is out here and retired, this is future you, future you will be reliant on whatever they can come up with, which will include Social Security, and perhaps if now you save some money, then future you can spend those savings. Let's think about retirement savings as your now you's present to future you. Future you isn't just anybody. Someday, now you will be future you. Future you will be older than now you. How much older? Future you will be wiser, a lot wiser, we hope. Future you will be something like now you, but still different. Now you may not know now when future you will retire, but now you may have some idea. How much will future you spend, we ask now you. And now you says, well, less. Some costs will disappear, won't have a mortgage, won't have to spend what I spend on clothes for work, although now after COVID, most of us spend a lot on clothes for work. But any commuting costs and other costs that we may put out in order to support our work. And now that we'll have more time, now that future you will have more time, maybe a little less on purchase services and like restaurant meals and that sort of thing. Now, Social Security benefits will be the base of future you's spendable income. The more now you earns, the larger the present, Social Security present, that future you will get, right? So if now you's earnings are low, then future you's Social Security benefits will be significant, but still not as large as they would be if now you is earning more. And now you should take that present into account when deciding how much to save. Otherwise, now you will feel pressured to save more than they need to, and now you will be resentful. Future you will be disappointed that now you didn't enjoy life as much as they could have. Now, if we think about future you and how much now you earns, we see that Social Security benefits increase with income, but not one for one. So at low income levels, or low, as we say here, very low income levels, about 80% of income here is replaced by benefits here. And this low tier or lowest tier of income, career average income of about $15,000. Over here in the maximum earnings tier, less than 30%, and we're reading the percentage of income that's replaced, and let me show you that. Over here on the right, less than 30% is replaced by Social Security benefits. This is less than 30% of this. So while in the lowest income tier, future you might not need any present to maintain their living standard, in higher income tiers, presents from now you are essential. We're going to push this present metaphor, and I'm going to use a package metaphor as well. We're going to push it pretty hard. And so we hope we don't push it to the breaking point, but we're going to use it throughout this discussion. So there are some questions that now you has to answer, and they're pretty practical if future you is not going to be disappointed. Today, we're going to talk about some of those questions. We're going to talk about how you can save. It's hard to save. Now you wants and needs lots of stuff. And so now you doesn't really want to save anything. They'd like to spend as much as they can. But if they're looking ahead to the present that they want to send to future you, then they're going to have to save something. And we're going to see if we can find some things that might help. And secondly, if we're going to think about retirement accounts are confusing. Which account to use, and here we say which package is best, and we're going to try to help illuminate that question a little bit. In June, we'll discuss the next two questions. Figuring out how much to save involves lots of math, and there's a lot of uncertainty, so we'll see if we can bring a little clarity to that. And then figuring out the right investments. There are so many choices, and a lot of people find it a little bit disconcerting to make choices about investments in retirement accounts. Now, why should we use a retirement plan to send future you a present? And there are several reasons on this page. The first one is mental accounting. If all your money's in one account, it's hard to remember what it's all for. Spending today, vacations later this year, a new car, retirement. If it's all in one bundle, it's hard to know how much is available for what. A named account or a dedicated account can really help make that clear. Secondly, even if you set up an account, let's say at a bank and made it a savings account and called it retirement, a big pot of money can be really tempting. You could have a new Tesla, for example. So restrictions on access to those funds can help you resist your temptation to buy a nice new car with that money that you'd set aside for future use retirement. Some retirement plans offer an employer match. Every little bit helps in terms of getting that present bought. And finally, you can defer or avoid taxes and get a higher net investment return. And that tax deferral is a big attraction of retirement plans because we're going to see that tax deferral helps a great deal. On the other hand, retirement plans are imperfect. Because of some of the benefits, there are some drawbacks. you may not be able to access those presents even if you need them. So barriers that help you resist temptation can get in the way in an emergency. And secondly, retirement funds can be expensive to tap in an emergency. And secondly, if you are the sort of person, and increasingly everybody is this sort of person, who moves from one job to another over your career, and some of your presents are set aside in employer retirement plans, you may end up with lots of these plans, and you don't want to lose them. This is a classic problem, by the way, that we see as in financial advisors. A lot of clients show up with a trail of retirement accounts from old employers. And if you're not careful, you can forget them, and they can get lost if you move and you change your address. They may not be able to follow you. Now, sending that present is pretty complicated. First of all, it costs now you. What you save, you don't get to spend. You incur shipping costs. We're going to call them shipping costs. They're taxes, they're expenses. And then a long time passes between the time that the package gets picked up and the time that future you, from you, now you, and the time it gets delivered to future you. Now, that long time allows for more growth, and that may mean a better present, but it may be that the present that you put in the package had some uncertainty associated with it, and that, or some risk associated with it. And that can mean that it's uncertain exactly how much present future you is going to get. So you got to be able to track your package and know if your present is what you want it to be and if it's moving in the right direction. The first thing you've got to do is figure out which retirement plan you're going to use, which package. There's a large number of plan types, and this list is not exhaustive. There are even more than I'm showing you here. And if we attempted to cover everything, we'd be here until the middle of next week, and even then we wouldn't be finished. So we're going to focus on a couple of, or a few that are most salient and most often used. So among individual accounts, those are the traditional IRA and the Roth IRA. And then among employer plans, we're going to look at 401ks and Roth 401ks, and 403bs and Roth 403bs. Now, a couple things kind of jump off the page. First is that there aren't any couples retirement plans. Every retirement plan, every recognized retirement plan is an individual plan. And secondly, there are different plans for individuals and employees. And the self-employed have their own plans so that they can make so that they can get employer contributions too. But again, we're going to focus on the ones in bold, the traditional and Roth IRA, and the traditional and Roth 401ks and 403bs. Now, the federal government authorized these basic plans, and you see the plans here. And all retirement plans that get federal tax treatment were sponsored or authorized by the federal government. And the federal government recognizes that it's important for now you to be able to send presents to future you. And in fact, they're encouraging it with the favorable tax treatment that they allow. Now, when you're thinking about a retirement plan, the type of plan that you pick, and the type is over here, sets the rules about taxation, contributions and withdrawals, and penalties. And those rules apply no matter where you decide to hold the account. And you can hold the account in a bunch of different kinds of places: banks, brokerage firms, mutual fund companies, even insurance companies. Now, I've indicated here that bank accounts and brokerage accounts, and let me see if I can draw a little bit better, and mutual fund accounts, those are all pretty standard for IRAs and Roth IRAs. You can also place them with an insurance company, but that's relatively unusual. And for 401ks and Roth 401ks, the mutual fund setting is the one that we see most. And then for smaller employers, insurance companies, and for 401ks and Roth 401ks, we also see self-directed brokerage, which I've shortened to SDB. And you see that, but not a lot. And not all 401k plans offer them. And those self-directed brokerage plans are very unusual in 403bs and Roth 403bs. The standard there is the mutual fund, but you also see insurance companies involved in 403bs, and TIAA-CREF is sort of the founding example there. I thought it would be interesting to see just a little bit of history on retirement plans. And in this country, we see them first back in the 1870s. The US and Confederate states offered military pensions to veterans of the Civil War. And then around 1875, American Express offered the first private pension. And as we go on, we see states and municipalities offering pensions for mostly for state and municipal employees, policemen, firemen, and teachers. And then early in the 1900s, Andrew Carnegie founded TIAA. And TIAA was set up to fund teacher pensions. The T stands for teachers. Then in 1935, we get Social Security. And after World War II, private pensions really boom. And there are sort of institutional reasons for that, but that boom in pensions extended very broadly. And a lot of large companies offered pensions. And they're called defined benefit pensions because they offered an annual income after retirement. In the late 50s and early 60s, we get 403b plans and KEO plans. And then in 1974, we see ERISA, and I can't remember what the acronym stands for exactly. It's Retirement Income Security, I think, Employee Retirement Income Security Act. And that regulates private pensions and authorizes IRAs. So IRAs are about 50 years old. It's not that long that we've had them. And then 401ks came in shortly thereafter. And finally, and this is a very large trend, we see a shift from defined benefits toward defined contributions. And that has huge implications because for defined benefit plans, the questions of who bears investment risk, who decides how much to save, who bears the disability risk, so if someone's disabled, what kind of pension do they get, who decides about how the benefits will be distributed, and who bears the longevity risk, who's on the hook if somebody lives a long time. With a defined benefit plan, it was all the employer. With defined contribution plans, it's you. And that's a huge change. Now, why did that happen? Well, it happened because pensions were really tightly regulated. And secondly, a lot of companies ran into balance sheet issues because they were funding their pensions with risky assets. If there were downturns in the stock market, then the pensions would look underfunded, and then they had to make big contributions, and that hit the bottom line. Companies don't like things that hit the bottom line. So they moved from defined benefit pensions, which were unpredictable, to defined contribution plans where they made contributions and employees made contributions, and that much more predictable. Now, that's a big problem for those of us who don't work, for those of us who had defined benefit pensions, and for those of us who now have defined contribution pensions, because the big companies that offered defined benefit pension plans had big staffs of very skilled and educated people that focused just on pensions. They had actuaries to help them figure out how much money they should put in to fund those offered or promised annual payments. They had investment managers to figure out how to invest. They had HR departments that manage disability. Most of us don't have staffs like that to address all of these very difficult questions. But future you is depending on now you to deal with all of this. And now you has big decisions. How much future you will want or need, how much to save, where to save, and how to invest so that future you will get what future you wants and needs. And now you has to take some big steps. Now you has to actually save. And now you has to manage your investments. So if we push the analogy here, if future you is going to receive the Goldilocks present, now you has to make all those decisions. Decide how much to spend, set it and save, set the money aside, pick out the present, buy it, pick out the box and the wrapping paper, wrap it and ship it. It's a lot to ask. Okay, so one of the first things we got to do is pick the box. Which package are we going to buy? Are we going to buy, is now you going to buy an IRA, a Roth IRA, a 401k or 403b, a Roth 401k or 403b? Now, I'm going to give you a high-level overview here of how the plans vary. And the detailed rules are much more complicated. And it's worth checking into those if your situation is not vanilla. If you're saving as your accountant advises, if you're withdrawing beginning at what's called the required beginning date, and you're taking required minimum distributions, you don't have to go into much detail. But if you want to do something a little bit different, then it's good to get professional advice, because these plans are very complicated when you push the envelope or go a little bit off the reservation, as it were, and you can make a mistake, and those mistakes can be expensive. So it's better, if you're going to do something a little bit unusual, to ask somebody for help. Okay, so as we look at these plans, the differences are in the areas of tax treatment, how much you can put in, income limits, rules on distribution, and what happens if you decide you want to take money out before you are supposed to. And the age at which you're supposed to be allowed to start is 59 and a half. So taking money out before 59 and a half is met with penalties. Taking money out after 59 and a half, no penalties. So let's think about tax treatment first. Traditional accounts, IRAs, and 401ks and 403bs, contributions are not taxed. So money that goes in before tax. It's income that goes in before tax. For Roth IRAs and Roth 401ks and 403bs, the money that goes in is after tax. It's taxed before you contribute it. When you take the money out, when you withdraw it, the traditional ones are taxed, and the Roth accounts are not taxed. So the timing of taxation is just reversed. That's the difference between traditional and Roth. Now, how much I'm going to skip over the annual contribution limits for a second, and we're going to talk about limits, income limits, for deductibility now. For deductibility for IRAs, single filers can't have more than 73,000 before they can make and deduct, importantly, the maximum contribution. And if they get over 83,000, they can't deduct any of the contributions that they make. For Roth IRAs, again, for single filers, direct Roth IRA contributions are allowed for single filers with incomes under 138,000. There's a phase out from 138,000 to 153,000, and above 153,000, direct Roth contributions are not permitted. And then in terms of distribution rules, with IRAs and traditional 401ks and 403bs, required minimum distributions have to begin at 73. For Roth IRAs and 401ks, no RMDs, no required minimum distributions. And finally, for early distributions, there are exceptions, and the exceptions differ between IRAs and Roth IRAs. Basically, the rules are if there's a good reason, but the government gets to figure out what's good, then you can take withdrawals without penalty. Here, education, a first-time home, if you're disabled, a large medical expense, those are good reasons, and you can take money out, certain amounts of money out for good reasons. With Roth contributions, with Roth IRAs, you can withdraw contributions at any time, but if you want to take earnings out, you've got to hold them for 5 years plus these reasons. And for 401ks and 403bs, there are, again, good reasons that you can, disability and some others. Now, what about how much you can contribute? The limits for IRAs and Roth IRAs are smaller, up to $7,500. For 401ks and 403bs, the limits are $22,500 up to $30,000 for people that are over 50, and your employer can kick in too. So the limits are much higher for 403bs and 401ks than they are for IRAs. Individual plans and employer plans are structurally different. So individual plans are more flexible. You make all the decisions, and you can take only your interest into account when you're choosing the investments and how much they'll cost and so forth. With employer plans, employers make the decisions, and since they're deciding for lots of people, there's less flexibility. Often the range of investment choices is narrower for 401ks and 403bs than it would be for an IRA, and the number of choices is also smaller. And then in terms of fund expenses and account expenses, it's the Army. You take what your employer chose. And with these are complicated plans. There are lots of helpers in sending your present along, and you don't have to worry about, once you've picked a custodian or your employer has picked a 401k plan, you don't have to worry about who's going to hold the assets and select the investment choice set and all that sort of thing. They take care of that, but you are on the hook, usually, to choose the investments. Okay, Carrie, we have time, I think, for a couple of questions here.
Absolutely. Okay. So Joseph asks, how does it make sense from a policy standpoint to go from a DB system invested by professionals and paying an annuity to a DC system invested by individual employees who have no background in the investment area and can take lump sum distributions or pay to buy annuities?
Joseph, that is such a great question. And that the answer is that nobody took that policy decision. Nobody decided that this was a case of unintended consequences, in my view. The regulation that was intense of these plans was designed to protect employees. The intense regulation of DB plans was intended to protect employees. But the problem with it was that the companies and the plans that were being intensely regulated didn't like it. And they had the choice of saying, well, if you're going to regulate us like this, we're just not going to offer the plans. And the regulators didn't intend that, but that's what happened. And secondly, the impact on the balance sheet and the impact on the profit and loss statement that those defined benefit plans had, again, wasn't intended, but companies just decided that it was more trouble than it was worth. It was a benefit for employees, and it turned out for employers that it was a more expensive benefit than they wanted to fund because of the compliance costs and because of the difficulty of smoothly funding the pension plan. So they just decided, employer by employer by employer, to stop doing it. So there was no explicit policy and no explicit policy decision. It just happened. And a lot of people were unhappy about it. A lot of professionals were unhappy about it. But no one thought it was important enough, and no one in Congress in particular thought it was important enough to do something about it to prevent the shift.
Okay. Well, someone asks, is it possible to get a copy of these slides? And I will say, yes, there is. It is. If you registered for this webinar, we have your name, and we're going to email you a copy of this presentation. So you'll be able to take a look at it again, or send it to a friend or relative that you think would be interested. There's another question. This is a biggie. You mentioned Social Security benefits as an important gift to future you. If you're young, if you're only in your 30s, will Social Security still be there?
I don't have any doubt that Social Security will be there. I'm not certain, and I think no one is certain, exactly how large the benefits will be. So I think as a younger person, it's not imprudent to plan for there being some benefits available. I think it would be imprudent to expect that benefits at the levels that we see them now will be available. And if you get your statement from the Social Security Administration, I would read not just the numbers, but also the statement from the trustees that gives you a sense of what kinds of adjustments might be necessary. Carrie, I think we should move on here. This is going a little bit. I think I may have been a little bit ambitious in the amount of ground that I hope to cover. So let's see if we can go back to it and work all the way through.
Absolutely.
Okay. All right. So now let's think about now you's problem, and let's think about how now you can make future you's present bigger. And there are at least 4 ways. One is to put more in the package. You could save more. You could make sure that as little as possible leaks out as expenses. That's spending less on expenses. You could make the package grow. Different investments grow differently. That's earn higher returns. And you can give as little to the government as possible, pay less in taxes. And we're going to talk about each one of these. How can you save more? Well, you've probably heard pay yourself first. And I would translate that to make a gift to future you before now you spends it. Intentionally saving or giving a specific amount produces more consistent results. And there's less money to spend impulsively. So you can make an automatic saving transfer when your paycheck comes in before you spend anything. And that's this model here. And we like this model. With an IRA, you can easily set this up. If you're working with an employer plan, there's no effort required on your part other than just signing up once, because the saving occurs before the money hits your checking account. Now, you can also have special savings accounts, and you can name them, and you can make touching them taboo, right? Whether it's an account that's a retirement account, an IRA or an employer plan, or if it's a taxable account that you've just set aside because you want to save money for retirement, maybe more than you can put in any of the formal retirement plans. When you name it, it's obvious that the money is for future you. And if there are restrictions, that makes it easier to keep now used MITs off of future use present. So the formal retirement plans, IRAs and employer plans, have those restrictions. Whereas a plan that you set up or an account that you set up not as a retirement, not as a government sanctioned retirement plan, but just an account, it doesn't have those restrictions. So you've got to use your willpower to keep it sacrosanct. Now you can save more, and you can do that by accepting your employer's contributions. Many employers offer matching contributions, and you can translate that to, if now you makes a gift to future you, your employer will also make a gift to future you. That means, wait for it, a bigger gift for a future you. Let's see, did that happen? Yeah, there we go. There's our bigger gift. Alternatively, it's free money, or you can think of employer contributions as compensation. You don't want to leave it on the table. Now, you got to be a little bit careful. If you get too enthusiastic, you may end up leaving money on the table anyway. Some employer contribution algorithms do the matching payroll by payroll. So suppose your employer matches the first 3%, and you say, I'm gonna set this money aside really fast, and I'm gonna save 3% of my annual pay in the first payroll. That's my whole contribution for the year. I'm gonna do it in the first payroll. You'll have contributed 3%, but the employer is only gonna contribute 3% of that first month's payroll. It's because it's 3% of pay is the max. And they're thinking about that pay as the max. That works out to about 0.25%. You're going to miss out on a lot if you do it that way. So you've got to talk to your HR department before you do anything fancy other than a fixed amount per payroll. So what presents can you put in your package? It turns out you can put almost anything in there. And especially with an IRA, you can put all kinds of things in there. You've got, if you've put it in a mutual fund, you can put a mutual fund account, you can put it in mutual funds. If you brokerage account, ETFs, individual stocks, individual bonds. And with alternative investments, and these are allowed for IRAs, you see you can put everything in there except these things down here. It's the footnote, the small footnote at the bottom of the page. So real estate, limited partnerships, private equity, almost any investment. Now, my opinion is almost nobody needs individual stocks and individual bonds or alternative investments. And I call these bright, shiny objects. They can distract now you from more important decisions like how much you should save, basic asset allocation, and keeping expenses down. So I would recommend that you keep with mutual funds or ETFs. Those are, which are a different kind of mutual fund, basically. There are also in 401ks and 403bs, especially, you can see there are something called target date funds, and those can be helpful for people who really want to simplify their investment decision. Okay. Just a moment. Okay, so second thing you can do is spend less on expenses. Expenses matter a lot. Low expenses leave more present for future you. High expenses leave a smaller present for future you. So your first step is to know what the expenses are. For IRAs, custodians will tell you how much they charge to operate the account, and mutual fund and ETF companies will tell you the fund expenses. For employer plans, HR should be able to tell you plan expenses, and the plan provider should give you a list of all the investments you can choose and what the fund expenses are. And now you has to choose the low expense options to take advantage of the benefits of spending less on expenses. If you want to earn higher returns, it's important to recognize that higher returns come with higher risk. So you got to think carefully about risk and return. And investment choices offer different return and risk combinations. The choice you make will have a significant impact on what future you will receive. And while it may seem as though your investment choices are kind of set and forget, it turns out that many now feel compelled to change them in response to changes in the investment environment. And your best results actually are going to be achieved when you have investments that now you is comfortable with and doesn't feel compelled to change. If we think about the investment choices broadly, you see them here. Money market funds or cash return very little, but the risk is very low. Bond funds tend to return more and the risk is and still relatively low, right? So with money market funds, you get a little more, the future you gets a little more than now you puts in. With bond funds, future you gets somewhat more than now you puts in. And with stock funds, future you might get a lot more, but they might actually get less. And so it's important when you're thinking about the risk or the potential for return to recognize that there is risk too. So to learn more about this, and we're not going to try to cover this, it's a big subject in this meeting, in this discussion. To learn more about it, you can read a book, you can consult a financial advisor, develop an investment strategy, a combination of investments that you can stick with and stick with it. Okay, tax advantage. Tax advantage is really the reason that we're having this conversation. That's really that's the big benefit of retirement plans. While other decisions matter a lot, tax deferral is the primary reason we use these plans. And we're going to spend a good deal of time on these benefits. The details are complicated, but the concepts are simple, and I'm going to focus on the concepts. I'm going to talk through each one. And as we'll see, tax-free accumulation is the primary benefit, and traditional and Roth plans both offer tax-free accumulation. And before we get into Roth plans and traditional plans, here is Senator Roth, the patron saint of Roth plans. I don't know much about Senator Roth, but I thought it would be fun to see him in person before we dig into the technical details. So here he is, his moment of in the spotlight. Okay, so we're not going to go into the math of compound interest. You've probably heard that compound interest is one of the most powerful forces in the world, and it's true. But we're not going to go into exactly why that's true. We're just going to suffice it to say that it's powerful, and we're going to look at the impact. So suppose that you put in $1,000 into your plan, and this is one set of numbers, and it's purely illustrative. Your results will differ, but we're trying to illustrate the concept here. So you put in $1,000, you invest in an investment that returns 4% every year. It accumulates for 40 years. And at the end, you've added to your $1,000, $3,800. The total spend is $4,800. The money has nearly quintupled just at 4% over 40 years. But that's with no taxes. And everybody has to pay taxes, unfortunately. Okay, so with taxes on growth, you're going to get less. Suppose you have a standard bank savings account. You put in $1,000, you wait 40 years, your money's almost quintupled again. Oh, but wait, you have to pay taxes. We're paying 25% every year on our 4%. That reduces the net or after-tax return to 3%. So $1,540 of your $3,800 goes to taxes. And we're left with a net gain of $2,260. So now we can spend about $3,300 at retirement. Your money still more than triples, but it's not nearly as exciting as quintupling. And then if this is this taxable account, you pay income taxes before you contribute, and those taxes cost you too. If you start with 1,000, you're going to pay $2,250 in taxes. So we're only going to be able to put $750 into the account. we're going to earn 40% a year. We're going to wait 40 years, but we're still going to pay those 25% on taxes. So it's still 3% after tax. And now we're going to have 2,450, not 4,800, not 3,260. So this is all in a taxable account. But Senator Roth says, put your money in my Roth IRA or employer account, and the government will tax your income before it goes in, but it won't tax your interest and it won't tax your distributions. So here's that tax on income. Here's the growth on the tax that we didn't get, but we still get tax-free accumulation on the $750. And we get to $3,600. Pretty nice. Not 4,800, much nicer than 2,260. Now, a traditional IRA, a non-Roth IRA or employer plan means no tax on now use income. The account grows tax deferred at 4%. And after 40 years, there's $4,800 in the account. Just like the pure tax-free case we looked at first. Isn't that nice? But we all know that's too good to be true. Because you have to pay tax on the money when you take it out, 25%. There's $250 on the $750 and $950 on the, what was it, like 3,800, right? So that's the tax, implicit tax on the growth of the tax here. So we're going to end up with $3,600. That should be a figure that's familiar. That's what we got out of the Roth. So which package should now you choose? Which one's best? We're comparing here on this page all three of the ones that we just looked at. So if now use tax rate on income and future use tax rate on income are the same, then the Roth and the traditional are the same, and there's no advantage for one over the other. But they're both much better than saving after tax, 3,600 versus 2,450. Now you should pick an employer plan to get the match, and then either a traditional or Roth IRA if they want to save more. Sorry, they should pick the employer plan and then either traditional or Roth, and it doesn't matter inside the employer plan. The Roth has a slight advantage because it's got more distribution flexibility than the traditional IRA. There are circumstances when the Roth would be more strongly preferred, and the important example or the leading example is if you want to make the largest possible retirement plan contribution, the Roth provides it because the contribution's after tax. So you can make your full contribution after tax. So for example, if the contribution limit is 6,000 and the tax rate is 25%, the traditional contribution of 6,000 nets you 4,500 after tax, but the Roth you can make 6,000 after tax. Now, it's usually the case, however, that now use tax rate is larger than future use tax rate. And in this case, the traditional account has a big advantage over the Roth. The Roth pays taxes now at the higher rate, 25%. And I'm showing here a future rate of 12%. Doesn't have to be that, but it's less. And so with the traditional, you get 4,220 after 40 years. With the Roth, as we saw, 3,600. So usually, and for most people, the traditional is going to be better because most people face a higher tax rate while they're working than after they retire. In some cases, and these are unusual, maybe a year or two when now use earnings are lower than usual, future use tax rate will be higher than now use. And then the Roth has the advantage. So here we've got I'm showing a 40% tax rate after retirement versus a 25% rate before. And now the Roth still generates 3,600, but the traditional, because we have to pay taxes after retirement is 2880. So in this case, the Roth is preferred. If there's lower tax rates for now you wants to pick the Roth. Okay, Carrie, we can take another set of questions.
Okay. Great. Let me just see what people are asking. Well, let's see. My employer provides a match, but I can't afford to contribute to my 401k. What should I do?
That is a little bit of a difficult question. We don't want to not get the match, right? Because then we're leaving money on the table. That's money that we could have, that now you and future you could have, that we're not getting because we're not making any contributions. So if it's a temporary situation, like you're having a really difficult year, you've got a lot of unusual expenses, then if you already have money in the employer plan, many plans will let you borrow money from the plan. And you can borrow money with the plan to put it back. And you can use the money you borrowed to make the contributions while you're short, get the match, right? And then pay it back. And that way you get the extra money from your employer, and you're still able to cope with whatever difficult situation you're facing. If you have a home and you have a home equity line of credit, you could borrow to make the contributions. And if your employer is matching your contributions dollar for dollar, you're effectively getting 100% rate of return on that money that you're putting in the account. That's pretty good, even if it's only for 1 year. So, and if it's a temporary situation and you're borrowing just a little bit from your home equity line, that can be okay. If neither of those work for you, missing a year or two isn't the end of the world. If this has been going on for a while and there's no end in sight, then I would suggest that you consider reevaluating your situation, because there's some concern that you're not going to have, that future you is not going to have enough resources when they retire, because now you is probably spending more than they should be.
Okay, here's another question. I have a 401k, but the fund expenses are really high. What can I do about that?
Another difficult question. The first thing is that there are usually some funds that are less expensive than other funds. So you can choose the less expensive funds. There has been a tendency for the expenses of funds to come down. So there are usually some funds, even if they're more expensive than you might find in a better plan, or if you had your choice of all of the best funds, then you can at least pick the ones that are less bad. Then you can save just enough to get the match in your employer plan and put any additional savings that you want to make in your IRA or Roth IRA. So you use the employer plan just to get the match and put in just enough to get the match, and then do the rest of your saving outside the 401k. And then if you leave your employer, it's important to roll that old 401k into a new one, and do that pretty quickly. Or you can also roll it into an IRA. Either way, you can migrate to a situation where you're paying less in fund expenses.
Okay, here's another question from Joseph. Would the after-tax savings analysis favor AT savings if higher ordinary income rate on IRA distributions and capital gain rate on after-tax savings?
I would say that if you are that the best asset to hold in a taxable account is stocks, if you're going to buy and hold, because you don't pay taxes on capital gains until you realize them. So you get tax deferral that way. So if you're a buy and hold investor, you do get that benefit of tax deferral from holding stocks. And so the advantage, the tax deferral advantage of IRAs and Roth IRAs is smaller in the case of stocks as an investment than it would be for bonds as an investment. That's right.
Okay. Here's another question. This is from Alan. My daughter has a 403B, and it's a high expenses, a 1.5% wrap fee. But the employer has a 100% match up to 5%. So I recommend she contribute up to the match, then put any excess in a Roth IRA, not the Roth 403B that is also available. Does that make sense?
Well, that makes sense as long as the total that she's saving is enough, right? So if the 5% of compensation or 5% of salary plus the amount that she's going to put in the IRA, either the Roth or the traditional IRA, is enough for her, then yes, that makes sense. If it's not enough, if she needs to save more, then I would save more in the, hold her nose and save more in the 403B, because she's still going to get the benefit of tax deferral, even if the expenses are high.
Okay. Daniel asks, when rolling over an employee plan to an IRA, what is the advantage of Roth versus traditional? Or is there an advantage of Roth versus
Well,
traditional?
it goes back to the tax rate that you're facing now, as opposed to the tax rate that the now used tax rate versus future use tax rate. If now use rate is higher than future use rate is going to be, then you want to roll it into the traditional, because you don't want to pay taxes now. You want to pay taxes later when they're lower. So that says roll into a traditional. If your rates happen to be lower now than they will be after you retire, then it makes sense to do the Roth. But that's, again, that's a pretty unusual situation. And if the tax rates are the same, then you might say, well, let me do the Roth because it's a little more flexible. But there's the advantage is going to be relatively small.
Okay.
Okay,
okay.
I think we should move, because I've got one more slide and we're almost out of time.
Right.
Okay. All right. So, in conclusion, saving for retirement is now use present to future you. Choosing the right retirement plan can help you make the biggest possible gift at the lowest possible cost. And you see here the choices that we recommended that you make: paying yourself first, keeping your retirement savings for retirement, accepting your employer's gift, watching and minimizing fees and expenses, maximizing your tax advantage. And tax advantage is the most important reason to use a retirement plan. And when I say use it or lose it, I mean you have to use it each year, because the opportunity that you have each year is available only that year. You can't make up for it next year. So choose a plan, figure out how much to invest, make it at low expense, and stick with it. Okay, that is this webinar. Next time, Frank Napolitano on the 18th of May will be talking about the basics of estate planning. And then in June, on the 28th, I'll be back to talk about retirement plan basics 2, how to use them. Thanks so much for joining us. Here's contact information if you'd like to get in touch. Have a great afternoon.